Welcome. Thank you for joining my mortgage financing during and after divorce. My name is Janine Downey. I've been in the mortgage industry for 25 years, a loan officer for the past 19 years. I started as a loan processor the first 6 years and have been working at Mortgage Express for 21 years. Over the past few years, I've specialized in helping clients going through divorce after seeing firsthand how the language used in divorce settlement agreements can significantly affect a client's ability to qualify for financing and achieve their housing goals. I collaborate with all members of the divorcing team, but the process always starts with your needs, priorities, and goals. My number one goal is to help homeowners like you make more informed decisions regarding your home equity solutions and mortgage financing opportunities during and after divorce. I do not give legal or tax advice. This slide outlines the five-step process I use to gather your financial and property information and determine what you may qualify for, whether that is keeping the marital home, purchasing a new home, or developing a plan for the future. I review all income sources, evaluate debts, whether they will be separated at the time of divorce, and collect all relevant details related to the property. What is your home worth? Hiring a certified divorce real estate specialist to determine the value of your home is often a strong starting point. Another option is to obtain an appraisal. However, it's important to note that if you proceed with a refinance, the lender will require their own appraisal and the value may differ. I also review who is currently on title and who is listed on the mortgage, as these factors are critical when evaluating refinance options. Why does title matter? Title shows legal ownership of the property. Anyone on title has a legal ownership interest. They generally must sign documents to transfer or refinance the property. A refinance typically requires all current owners on title to either stay on the loan or be removed through the transaction. Why the mortgage matters. The mortgage shows who is legally responsible for the debt. Only borrowers on the mortgage are obligated to repay the loan. A refinance is essentially a new loan that replaces the existing mortgage and resets the ownership as well as the obligation. Because of that, the lender must verify who owns the property. The lender must determine who is responsible for the debt. Anyone on title typically must sign to transfer or refinance the property. If one spouse is being removed, the refinance is what allows removal from the mortgage and often removal from title. In divorce scenarios, this becomes critical because one spouse may want to keep the home and refinance into their sole name. The other spouse needs to be released from both title and the loan. If title and mortgage aren't aligned, it can create delays in refinance approval, legal exposure for the spouse trying to move forward, enforcement issues in the settlement agreement. Typically, no minimum time on title is required for a rate and term refinance. As long as the borrower is on title and qualifies financially, they can refinance. Timing does matter with a cash out refinance. Many lenders require a borrower to be on title for 6 months before they can take cash out. This is to prevent rapid flips or fraud. If one spouse is being removed via divorce settlement, lenders will usually allow refinance immediately after a court order or quitclaim deed. The key is documentation, not time on title. What underwriters are focusing on instead of how long on title, lenders care about is the borrower legally on title now? Do they have full ownership rights to pledge the property as collateral? Has there been any recent change in ownership that could be viewed as a risk factor by the lender? In summary, home value, title, and mortgage alignment all work together to determine refinance eligibility and strategy, especially in divorce-related transactions. When lenders look at employment income, there are several guidelines to consider between W-2 income versus self-employment and salary versus hourly. If we plan to use support income for qualification purposes, we'll typically need to document a 6-month history of receipts, along with evidence that the payments are expected to continue for at least the next 3 years. Lump sum payments can be challenging to use for mortgage qualification purposes. Depending on the amount received, there may be options to structure those funds in a way that allows them to be considered as qualifying income. Social Security and retirement income can also be used if they meet the applicable lending guidelines. During my analysis, I ask you for a copy of your free credit report to review your debts. I ask if you've discussed who will be responsible for which debts, so I can add this to my divorce mortgage planning report. Understanding all of your options regarding the marital home is where I can help. One option is to leave the existing mortgage in place, depending on how title and the mortgage are currently vested. It may be important to notify the existing mortgage servicer to avoid potential enforcement of the due on sale clause. This is the Garn-St. Germain Act. This federal law provides important protections during divorce by allowing a spouse's ownership interest in a property to be transferred to the other spouse without automatically requiring the existing mortgage to be paid off. However, the spouse remaining in the home is still responsible for complying with the terms of the mortgage. Another option may be a loan assumption. A loan assumption allows you to take over the existing mortgage, including the current interest rate and payment terms. In this process, you would apply with the current loan servicer and qualify for the payment on your own without your spouse. This can be a time-consuming process, so it's important that your legal team is aware and allows sufficient time within the divorce settlement. If approved, the servicer would remove your spouse from the loan obligation. If an assumption is not an option, another solution may be an equity buyout, where you keep the home and complete a refinance to remove your spouse from title and the mortgage, while also accessing funds to buy out their share of the equity. The divorce settlement should clearly outline who is retaining the home, the agreed upon buyout amount, and the time frame allowed to complete the refinance. Alternatively, you may choose to purchase a new home. In that case, it's important to consider whether the down payment funds will come from the equity received through the marital home or another source. Another option for those aged 62 and older is a reverse mortgage. This is oftentimes referred to as a silver divorce. I had a divorcing client that had been married over 40 years and they were both in their 70s. Both retired, living on Social Security, not a lot in savings, but they owned their home free and clear. They had stayed married because they thought they couldn't afford to be divorced, living separately. After I shared how a refinance reverse mortgage could work for the spouse keeping the marital home and a purchase reverse mortgage for the spouse departing the marital home, they were relieved to learn they could both start over. One of the biggest benefits of a reverse mortgage is that no monthly mortgage payment is required. Homeowners are still responsible for property taxes, homeowners insurance, and HOA dues if applicable. For many of my clients living on Social Security or a fixed income, this can be a win-win by reducing monthly expenses while allowing them to stay in their home. This is part of the divorce mortgage planning report I create for my clients, designed to help you understand and evaluate all of your home financing options. Every situation is unique. It goes back to the definition of divorce. It's a reorganization of your legal obligations. Most lenders prefer that the divorce be finalized before closing on a mortgage loan, so they have a complete understanding of the borrower's financial obligations, assets, and income. In certain situations, however, other legal documents, such as a signed separation agreement or property settlement agreement, may be acceptable in lieu of a final divorce decree, depending on the loan program and lender guidelines. Here's a sample divorce mortgage planning report that I prepare for my divorcing clients. This one is for Jane Doe. The property details section covers the home's value, title, and vesting, along with property tax and insurance information. In this example, the clients have a recent appraisal and both spouses have been on title for over 12 months. One thing that stands out is that only one spouse is listed on the homeowner's insurance policy. That could become an issue if the other spouse needed to file a claim and wasn't named on the policy. It's a small detail, but an important one to check during the divorce process. During a divorce, it's common to focus on the mortgage and title, but insurance is equally important. If both spouses own and occupy the home, it's worth confirming with the insurance provider that all parties who should be covered are properly listed on the policy. Next, we have information on the current first and second mortgage loans on the home. Only one spouse is currently on the mortgage notes. There is also an escrow balance associated with the first mortgage. An escrow account is when you include taxes and homeowner's insurance in your mortgage payment. The lender collects all year and pays each of these when they are due. That's why there is a balance at all times. When the loan is paid off, whether through a refinance or the sale of the property, any remaining escrow balance is typically refunded by the mortgage servicer to the borrowers on the loan. Because escrow funds are tied to the loan account, the refund is issued based on lender servicing records. However, how those funds are ultimately divided between the spouses can and should be addressed in the divorce settlement agreement. This is an important detail for your divorce attorney or divorce team to clarify so there is a clear understanding of how any refunded escrow will be handled between the parties. This section reflects the qualifying income used in the analysis. In this example, Jane Doe has not yet received spousal support for a full 6-month period, so it is not currently considered qualifying income. Once she has a consistent 6-month receipt history, this income may then be used for qualification purposes since it will continue beyond 3 years. The child support income is not expected to continue for at least 3 years. Therefore, it does not meet the requirements to be considered qualifying income. On this screen, we can break down your consumer debts and who will pay what. These populate onto the equity buyout screen and the new home purchase screen. This slide shows 3 examples of equity buyouts. The first example on the left wouldn't work because she is paying off consumer debt of $8,000 and the loan to value is over 80%, which is not allowed with a rate and term refinance. The second example works, but she would not be able to pay her ex half of the equity and keep the loan to value under 80%. In the third example, if she removes the $8,000 consumer debt, then it becomes a rate and term refinance and she is allowed to go above 80% loan to value because the HELOC was purchase money. This is something I definitely elaborate a lot more on once I have created a report for you specifically. I go over this on a Zoom call or in person, whichever is most convenient for you. To sum it all up, it's important to have a good divorce team on your side while you go through one of the most difficult times of your life. I would be happy to be the CDLP piece of your divorce pie.